So I want to tell you a little bit about the research that I've been doing on this important topic of savings gluts. And I'm particularly interested in the interaction between savings gluts and financial stability. So as you know, in some countries over the last few years, the years leading up to the Great Recession, a big topic of conversation was these global imbalances that we saw around the world. The fact that countries such as China or Germany were running large current account surpluses, which means that they're saving a lot of money, so they need to hold essentially foreign currency denominated assets. In the case of Germany, they need to hold non-euro assets. In the case of China, they need to hold non-renminbi denominated assets. And these kind of development has been blamed for a lot of the funny behavior of financial markets in some countries over this period. So, I want to dig into this and understand it. And I'm going to start with a simple example. So I'm interested in this issue of what are the consequences of combining large savings pools. Someone was talking about pension funds, but also insurance companies, sovereign wealth funds, wealthy individuals, nations, and so on and so forth. When we have open and integrated international capital markets, and what are the impacts for things like asset prices, the stability of national financial systems, and also economic policy. How should governments react to this big, large pool of savings traveling the world, searching for yield, searching for assets to park themselves? So let me tell you about this country, Spain, dear to my heart, because I'm from there. Let's just, I was trying to summarize as much information as I could in a single plot. So the black line is the current account surplus of Germany from 2000 to 2012, which is the onset of the Spanish banking crisis. The red line is the current account deficit of Spain during the same period, and is reported as a percentage of GDP on the left axis. So as you can see, at the peak of the Spanish cycle, which was tremendous, I mean, if you think that the United States had a big real estate bubble, a big imbalance, you have seen nothing until you see Spain. So at the peak of the cycle, Spain is borrowing from the rest of the world 10% of its GDP. Spain is the second largest borrower in the world in dollar terms. And Spain must be around the 15, 16 economy in the world in terms of size. So the first one, of course, is the United States. The second one is Spain, that is borrowing to the tune of $100 billion per year. Well, who's lending us that money? That's what you have to ask yourself. Well, essentially anyone who's running a current account surplus with us, the leading culprit being, of course, Germany, who is a big producer of a lot of things that Spaniards want to have, those wonderful BMWs and cars that Spaniards like driving around. Well, at the same time, essentially, there was a massive real estate bubble taking place in Spain. These are housing prices in Spain in exactly the same period, from the year 2000, which is essentially the beginnings of the euro, to 2012, which is the onset of the Spanish banking crisis. And what you can see is that there's an eerie correlation between housing prices and the current account deficits that Spain was running at the time. And the reason is because the way to think about what was going on is not exactly through the current account. Linking it a little bit to what Suresh was saying, one way you can think about this plot is through the capital account. That what is happening is that there's a lot of foreigners out there that, for whatever reason, we don't need to get into that right now, want to hold Spanish assets. Spanish houses, infrastructure projects, businesses, and so on and so forth. In the process, they end up lending to the banks, and the banks need to do something with those funds. And what they do, well, lending against collateral is always a good idea. And what is the ultimate collateral in the banking business? Real estate. But Spain cannot produce houses fast enough. So the prices go up dramatically. There was a phenomenal supply response in Spain. At the peak of the cycle, Spain is producing more houses than Germany, Italy, and France combined. Spain is smaller than any of those three countries. But we're building so many houses to generate those assets that foreigners want, that we have this massive real estate cycle combined with this very strong appreciation in the value of those assets. Well, how are these funds being negotiated in Spain? So essentially, Spain is a banking economy. Everything gets intermediated through the banks. Spain has some massive banks. Only Santander, our largest bank, has a balance sheet that is the same size of Spain's GDP. Okay? It's a global bank. They're very good at absorbing funds. And of course, they have a great expertise in redeploying those funds in Spain. Now, typically when you think about a bank, you think of it as funding itself with deposits, some equity, and a little bit of wholesale funding. What you see in the blue line is that the Spanish banks, at some point, precisely when the real estate cycle gets going in earnest, it starts essentially issuing debt in order to actually meet the demand for Spanish assets that foreigners had. So the leverage of the Spanish banking sector increases dramatically as a result. So much that at the peak of the cycle, the way to think about the Spanish banks is essentially like a leveraged real estate hedge fund. That's one way you can think about it. You have a bunch of financial institutions borrowing abroad in order to invest in Spanish real estate. But what was going on with the quality of the loans that were being issued? In red, you have the non-performing loans, the percentage of those loans that are delinquent after 60 days in the Spanish bank's balance sheets. And what you can see is that Spain was a sea of tranquility for a while. It is not surprising. You issue the loan, there's a massive real estate bubble, so the collateral keeps increasing in value. So should anything happen with that loan, the bank can always repossess that building, can always repossess that infrastructure project, can always repossess that commercial real estate property, sell it, and make good on the loan that they issued in the first place. But essentially, once the crisis hits, look at what happens to the non-performing loans. It goes up. Those are all the loans that were issued here. They look good for a while, but eventually, you know, as Warren Buffett said, when the tide goes down, you can see who's swimming naked. Spain was swimming naked. Not a pretty sight. Okay? Now, Spain is a relatively small economy, and even though there was a massive supply response, asset prices grew quite a bit. Just to give you an idea of the magnitude, this is exactly the same plot, but in this case, for the United States. So in red, as before, you have the current account surplus as a percentage of GDP. GDP of the United States is around $16 trillion. The GDP of Spain is around $1 trillion. Okay, so 6% of $16 trillion, a much bigger number than 10% of $1 trillion. That's why the United States was the largest borrower in the world. And who are they borrowing mostly from? Well, who is running a bigger current account surplus? The Chinese. Okay? And again, you see kind of a very similar pattern. What you see is that the Chinese want to hold, they want to have a portfolio in dollars for whatever reason. They want to, and the United States needs to generate those assets in order for foreigners to hold these dollar-denominated assets that are in such a high demand. And the way we generate those assets is by basically creating projects in the United States, real estate, again, being the favorite project to create, in order to satisfy the need to have dollar-denominated assets. Now, in the United States, because of the type of data sets that we have, we can actually take a look at the quality of the mortgages that were being issued during this period. And it's kind of an interesting plot. So I was thinking of how best to present this interesting fact for you guys. Let's see if I succeeded. So each of these lines represents a mortgage issued in a particular year. Let's focus in the year 2000, which is in purple. Okay? And here you have essentially the percentage of those mortgages that are already delinquent after a certain number of quarters. So that basically means that after, say, 6 quarters, okay, around 50 basis points of those mortgages are delinquent, okay, in the year 2000. Now, what is happening here? Well, as the real estate cycle in the United States gets going in earnest, it looks like, once again, the quality of those mortgages is improving. It's not surprising. Prices are beginning to go up. If there's any problem, you can always liquidate that loan, make good on them. And people can refinance easily because the house that they have is worth more than what it was when they took the mortgage in the first place. But eventually, things start souring. Look at what happens with the percentage of mortgages delinquent after any number of quarters in the year 2005, 2006, and 2007, when the financial crisis starts in the United States. So there's a deterioration, effectively, of asset origination standards that is going to compromise the viability of the Spanish banks and the American banks, essentially, when the music stops. Okay? So these savings gluts have tremendous implications for financial stability. And that's a little bit the work that I've been doing over the last 3 or 4 years. And there you have some of the work that I've done with Patrick Bolton, also a colleague of ours at the Columbia Business School, Jose Shakeman in the economics department. I wrote this piece for the Bank of International Settlements, trying to basically give an overview of what these credit booms can do, both in the public and the private sector, and what it can do to the political systems of the countries that are the recipients of these big savings gluts, and the type of distortions that happen in the political economy of these countries as a result of these large inflows coming from the rest of the world. What is the main idea of this research? It's a very simple idea. Basically, what happens is that what you see in the data is when these savings gluts happen, basically these foreigners want to buy everything. They're very indiscriminate. They go and they buy the high and the low. Okay? Now, in the process, because the supply response cannot be fast enough, essentially the only way to clear those markets are through increases in the prices. But that basically means the prices of everything goes up. And that basically means the spreads narrow between assets of high quality and assets of low quality, which essentially lowers the incentives to produce assets of high quality, because if they're going to pay me the same price for a high quality asset that is costly to generate as they pay me for a bad asset, I might as well generate the bad asset. It's cheaper for me to generate a bad asset. I'm going to grant a loan to Suresh. I have to find out whether he's a good risk or not. But given that you're going to pay me 100, I don't ask him anything. You're going to pay the same price for a good or a bad asset. Why do I spend any effort in trying to screen borrowers? Okay? The Spanish finance minister had a beautiful line when Spain ran a very sensible fiscal policy throughout these years because they were worried about what would happen when the music stopped. But our spreads were exactly the same as Italy, a country that was running not a very good fiscal policy. Okay? They were running large deficits when Spain was running surpluses. And he said, what is the point of being a good guy when you're going to get exactly the same yields as the Italians, okay, who are not running a sound fiscal policies? Okay? So essentially what is going to happen is that you're going to generate all these assets. Eventually the quality of these assets to generate, but you're not going to see it for a while. Okay? And simultaneously you're going to start funding a lot of these assets through debt, because debt, foreigners don't want the equity because they don't understand the peculiarities of that particular real estate deal. They want the debt, and you take the equity side of the deal because you are the local investor. You know exactly the type of risks. And as a result, what you're going to get is a combination of bad asset origination and leverage. And what the models that we've been playing with in order to conduct policy experiments look like this. So think about here having the savings glut. This is the amount of capital flowing into a particular country. And here you have the average credit quality of a loan in the asset side of the balance sheet. Think about this as being the leverage that the bank is taking. And what these models are able to deliver, and that's why we're excited about them, is that they can deliver this interesting nonlinearity. That at the beginning, everything looks good and peachy. Okay? Leverage is increasing. But eventually, the quality of the assets on the asset side of the balance sheet of these banks starts deteriorating, even though the leverage keeps going up. And eventually the music stops, and we're caught with bad assets and high leverage. We have a banking crisis. So what are the implications of all this? Let's extend a little bit our discussion, and perhaps we can relate it to some of the things that Suresh was talking about in his remarks. So as he was saying, this is a good time for real investments with long durations, okay? So it looks like the golden age of infrastructure investment is upon us, okay? And why is that? Because essentially many countries need to save, because in an environment where growth is going to be lower than expected, and we have all these liabilities outstanding through insurance companies, pension funds, welfare systems, we need to save a lot to at least make good on a percentage of those promises that we have made in the past in the next, say, 20, 30 years. So everybody wants to save. Everybody's freaking out because we realize the pie tomorrow is not as big as we thought it was going to be. The question is that, think about in Spain, for instance, we went through a massive cycle. We have the best high-speed train network system in the world right now. It's spanking. If you go there, it's brand new. We have a wonderful highway system. We don't need any more of these infrastructure projects. We already have too many ports. We have empty airports in the middle of nowhere. Don't buy an airport in Spain. It's a crazy idea. So the question is, which are the countries that can generate these assets, and do they have the governance structure in order to generate these assets? And so let me just tell you, while I was listening to Suresh, I was thinking about this example, which is, I was thinking about the country of Liberia, population 4.2 million. Liberia is sadly not a very rich country. It has an electricity grid that produces at peak less energy than the Dallas Cowboys Stadium, okay, that can seat, about 1% of the population of Liberia. It's around 50,000 people who sit in the Dallas Cowboys Stadium. Now, if there's a positive MPV project in the world, it must be to give the good people of Liberia a good electricity grid. Why cannot it happen? What is preventing that electricity grid, which is clearly a positive MPV project? It would make the people of Liberia very happy to be able to, cool their houses with AC, warm their houses in tough weather conditions, do all these things that we need an electricity grid for. Okay, well, it's precisely the governance issues that Suresh was talking about. Now, how are these big pools of capital going to be intermediated? Well, there are three possibilities. They can be intermediated through governments. So governments can borrow in order to actually go and undertake those large infrastructure projects, okay? So think about, if you want to think about Europe, think about Greece doing that, okay? Or Portugal did this in Europe, okay? And here the issues that we need to contend with, as I just said, are things like property rights and stability of the institutional framework, governance, issues related to corruption. There's nothing, let me talk briefly about this. One of the most lethal things that the inflow of funds from the rest of Europe did to Spain is that it corrupted completely our local political class. Why? Because, they understood full well that if they granted quickly that permit for that big project, it was going to bring an enormous amount of prosperity to their communities, and that would get them re-elected. So the temptation was to grant those permits a little bit too quickly and get a kickback in the process. Why not? There's so much money. Everybody's so happy. And yes, perhaps someone has a sniff that something is going on, but everybody's getting so rich in the process. And what happened is that completely decimated our local political class. They're all going into jail these days. Okay, it's a lot of fun to watch. Okay. Now, it can be intermediated through the national banks. Okay, to some extent, that's what happened in Spain. And here, issues of governance are important. But then you have to strengthen your supervision and resolution tools, because that when big pools of funds are being intermediated through the banks, through the banking system, eventually you will get a problem. This is not something about India or Spain. It happens to everyone. It happens to the Americans. It happens to the Spaniards. It happens to the squeaky clean Swedes. It's just about banking. Banking is a messy business. There are bad incentives built in the structure of these financial institutions. You get into this banking crisis time and over again. Okay? Now, a very important thing, when you have a weak financial system, there's a very perverse effect that we were able to identify in our research, that weaker financial systems may be quicker to supply the assets that foreigners want. You know, if you think about this, if you're a very good bank and you're going to basically check every loan that you're going to be issuing, then you may be very slow in generating those loans, okay? Whereas if that other guy right in front of where you're sitting doesn't care about that, he's just happy to generate those loans, those mortgages, those assets investors want, you know, those are the guys that are going to be able to issue a lot of these mortgages very quickly. Given that foreign investors don't seem to be very discriminating, they're going to end up, or we're going to end up generating a lot of bad assets in that particular country. And finally, corporations, what you guys refer to as external commercial borrowing. Okay, so firms will actually do this as well. And one of the striking things, I was basically fooling around with the data set of the Superb website. It's available in the Superb website of the Reserve Bank of India. And you have wonderful data that allows you to keep track of who is borrowing what at what time on a monthly basis. So this is the latest issue of the external commercial borrowing as provided by I just basically selected the companies that were borrowing more than $1 million. But there are some guys who are leveraging up quite a bit. Now, in the process of thinking about these savings funds, of course, you have to think about this issue of slow versus fast money. You want this foreign investment. It's very good to have this foreign investment. The world is hungry for Indian assets. The world is hungry for Brazilian assets or African assets, of course. Okay, we want these vehicles in order to invest, okay? But you want to make sure the commitment of these funds is for the long run, okay? Because if not, okay, you're going to be exposed to a lot of variation in your returns that is driven by exogenous shocks, and that, of course, calls for a lot of risk management inside corporations, but also inside central banks as well, who may want to actually engage in aggressive hedging of foreign exchange exposure when you know your capital account is growing dramatically, okay? And here, issues like the swap lines that the European Central Bank and the Federal Reserve Bank have with each other are going to play a critical role in the future, okay? So just to give you, of course, you're all familiar with this plot, is essentially the exchange rate between the rupee and the US dollar. And you can see immediately, even for a country of the magnitude of India, what the taper tantrum did to the exchange rate. It led to a very strong devaluation of the rupee vis-a-vis the dollar on account of essentially a statement put out by the Federal Reserve saying, well, perhaps when pigs fly and cows sing, we may think in the future, in 20 years, that we'll lower interest rate, and all the world freaked out, and we're pulling funds from everywhere. And this is for a country the magnitude of India. So just imagine smaller countries, the way they're going to be exposed to this type of shocks. Is, for those of you who took the value investing class with me, this is going to be fantastic because it's going to give us wonderful investment opportunities from time to time. So it's going to be horrible from a macroeconomic point of view, but it's going to be wonderful from an investment point of view, okay? So there's a silver lining to everything. Now, think about, you know, the issue of the quality of asset origination being key. Large countries, just simply because of the size, okay, can have kind of a strong supply response. You know, so Suresh was talking about these infrastructure projects for which there's an enormous need in India. So if you are able to supply just a little bit in terms of these assets and solve these governance issues, essentially you can attenuate the price response, okay? There are only a few countries that kind of can do this in sufficient magnitude just because of the size of their economies. Essentially the US, which if the current administration carries the plans they are advertising, is going to have a massive infrastructure project in place for the next 10 years, obviously like India, Brazil, and China, okay? In small countries, you think about small countries in the world as being little boats in a big storm, okay? So you have, you know, there's something for having a good captain in a small boat during a storm, but that's the best you can hope for because it doesn't matter how much your supply responds. You know, there's a limit to how much you can supply given the enormous flows of funds going about in the world looking for investments. So you're bound to have a strong price responses. And of course, that's everyone else. Okay, everyone else. So one of the examples that I always tell my students is that of the Philippines. So the Philippines is a country, I should have plotted the foreign direct investment because it's quite an impressive plot, but I, thought it's already too many plots. But if you look at what has happened to the Philippines, once the Federal Reserve and the European Central Bank go into quantitative easing, is that they start receiving massive inflows of funds from hedge funds. Now, you don't need that much to move the Filipino market for any risk, whether it be equities or real estate, okay? And it's almost that you can time it perfectly. Once the QE programs start getting announced, look at what happens at the residential and commercial property prices in the Makati, which is the business district in Manila. It starts going up through the roof. And, I encourage you to, for instance, look at the Filipino stock market and just what happened to the stock market there during the taper tantrum as well. You immediately have this. And there's nothing, by the way, the central bank can do. The flows are just too enormous for a small economy. And this is only a 15 billion, I think the number is $50 billion inflow that made for these massive moves in markets inside the Philippines. So let me just conclude, and we'll leave some time for questions. So we live in the age of the capital account. That's one way you can think about it, where we're going to have these massive portfolios looking for investment opportunities and exposure to many different risks and currencies, okay? The way I want you to think about this is that we're going to see some massive savings gluts interacted with integrated capital markets, and this can produce massive infrastructure investments, so many good things can happen across the globe. So those countries that get their act together from a governance point of view will be able to benefit from these unique conditions of low interest rates and demand for long duration assets, okay? And that can produce a wonderful convergence in living standards. So there's some real effects that can be quite good, okay? In the process, we're going to get massive volatility in financial markets and a lot of banking fragility because all of a sudden, many financial markets around the world are going to be exposed to kind of shocks they were not exposed to before, policy shocks coming mostly from the countries that are the responsible parties for these savings gluts. Now, there's one risk, and connecting a little bit to recent political events, and it's this thing of globalization and its discontents, okay? That perhaps, we're going to basically undo a lot of these trends that we have done. I think the returns associated with some of these things are just simply too enormous. The returns associated with endowing a great country like India with infrastructure needs that it has are just too big, okay, for this. But in any case, it's not as worrisome as it looks. Because to me, the future looks very local. It doesn't look very global. It's quite of the contrary. I don't understand why. Think about infrastructure. Infrastructure is a purely local asset. It has to be serviced by a local company. It's not that you're going to fly in, say, an Italian team of workers to actually take care of that particular highway that is linking two Indian cities. This is not going to happen. It's going to require a lot of local services to maintain those assets. And given that the world is becoming a service-oriented economy, services, think about healthcare, education, to some extent leisure. Some of leisure is provided internationally, but a lot of the leisure, the local concert, the local play, the local, your favorite singer that you go to, those are going to be very local things, okay? Senior healthcare, for instance, that is becoming a very important problem in the Western world. Well, we cannot fly an Indian nurse every day to give the pills to all these seniors in Florida. This is not going to happen. It has to be someone who is located there. So the future of the world looks particularly local to me more than global. So this thing of globalization being at risk seems to exactly upside down. Thank you.